Hello, everyone. Welcome to the channel. This is Fair Value Finder, and today we're taking a look at Ulta Beauty and why the heck the stock is down so much. It recently hit a peak of $556.60 back in May, early May, and has been on a downtrend ever since. So we're going to take a look at the stock and see if it's worth buying now that it's down over $100 from that point. We have here a series of lines. For those of you who watch the other videos, you know that our margin of safety, where a value investor would be looking to get into this stock, would be down here, probably about the $350 mark. Decent fair value for the stock would be right around $408, and then someone will want to reevaluate their position at 433 because things are getting a little overpriced. I have this blue line in here because this is a very strong support and resistance that the stock has experienced a few times. So that is something to note. If it does continue its downtrend, it might be going down to that 370 level and hovering there for a little bit. And then there's a really long uptrend going all the way back to 2009. This stock has gone almost straight up since then. If anyone bought their shares for $4.11 in 2009, congratulations. You 100x to your money. But if it were to get back to that trend, we'd be looking at the stock falling all the way back to around the $300 level. I don't expect that to happen. Last time it took a pandemic to do that, and I don't think anyone wants another one of those. So that is what we're looking at for the chart, and now we can get into the numbers and see what is going on there. So I put together a little dashboard that gives us all the important information about the stock, so that way things aren't so messy, it's nice and clean, and honestly, I could look at this and really base a decision on whether or not I want to buy, hold, or sell a stock. So we're looking at, as I said on the chart, fair value right around 408, a margin of safety of 15%. I mean, we can make this 20% if you really think that things are going to be rough. If there's going to be a big recession, I mean, you go 20% here and you'd say, I'm looking to get into the stock 326. But typically 15% is the value investor way. And then we'd want to reevaluate around 433, make sure the thesis is still the same. And if not, potentially look for other better options for the money. So earnings yield. This is the portion of the current share price that the company is going to make in their earnings for the year. And typically we're looking for something, I mean, better than you could get in bonds or in savings these days, honestly. So we're really looking for something over 5%. It gets a yellow because 3.86 is not bad, but I'd like to see that higher, 5 and above, ideally. Cash flow yield looks great though. Again, we'd want to see that above 5. So this is the amount of the net that is making it to cash flow, 11.46%. And then we have cash flow growth down here. They've been growing it over 30%, compounding year over year. So amazing job there. Dividend yield, they do not pay a dividend. That is one issue I have with the stock. You guys know I don't like stocks that don't pay dividends. With them, the insane growth that they're putting up, I'm not surprised though. So this is definitely more of a growth stock. But if the price continues to fall, it definitely has some value potential. ROE, 63.39%. Very good. We're looking for something above 20, ideally in that 20 to 60 range. But this being so high makes us want to look at the debt and see if the debt is skewing this number. And next to this, we have the debt to equity, 1.74. We really want to see this under 1. So it does look like they have quite a bit of debt, and we can go over here to this balance sheet page and see exactly what's going on. So assets aren't growing super quickly. Liabilities, their debt seems to have a bit of a better trend. And we can do a numbers comparison. Looks like 2022, they were just over 5,000 on this chart. And for debt, they were just shy of 3,500. So they're not super close, but the liabilities are definitely outpacing the debt in growth. So that's something to keep an eye on, especially since when we get down here, we see that asset growth is slowing down. 3-year compound annual growth rate of 3.36, 2-year of 2.72. Liabilities 4.82, 5.05. So it's bigger and it's growing while the assets are shrinking. Gross margin looks good, 39.62%. 30 to 50% is a great range. Even higher would get the green, but like 30 above 30% is not bad. And net above 10% is not bad. And then we can get into the actual growth of everything down here. So all in all, I'm looking at a hold on the stock. I think it would be a whole lot better if the stock price did go down to around the $350 range, because that would improve this number. And their debt to equity, they're just going to have to work on that one. And we're going to have to look and see how things are growing year over year for all three of these and see if they're on a good track. Because if the debt to equity is trending down, gross margin's trending up, net margin's trending up, but they're yellows, it could still potentially warrant a buy. So revenue growth, 3-year compound annual growth rate, 11.33%, 2-year, 28.82%. So great growth they're putting up. We want to see those double digits. But analyst projections are definitely slowing down. Next year, we're only projecting 9.12% growth, and 2 years out would be a compound annual growth rate of 6.96. So I feel like this is one of the major reasons that the stock is falling, because it trades well in line with earnings and a PE ratio near 25, 23 to 25 typically. And that's off of really high growth rates. But if the growth rates fall, then the PE multiple falls. And so it's kind of just experiencing multiple compression right now. Cash flow growth rate, we already talked about. Earnings per share growth, 18.04 for 3-year, 21.72 for 2-year. Analyst projections going forward this year, 1 year, 32.73, 2-year compounding, 18.52. So they're holding on with that earnings per share growth, regardless of the revenue declines. So that is something good. That's where most of the value comes from the financials. It is impacted by the revenues, but the earnings are the main driver. Share count, we want to see them buying back shares, and that's exactly what we're seeing. 2.86% 3-year, 2.62% 2-year. We talked about assets and liabilities, and they don't pay a dividend, so there's nothing to see there. And then we already looked at the balance sheet. They do have a positive tangible book value, which is another thing that we look out for. Cash flows, how are they trending? A dip in 2020, no surprise there, but they're on a nice little stair step up, so that's great. Non-existent dividend, and all the prices graphed. So the balance sheet really doesn't contribute a whole lot to the value historically, and it grows pretty slow. And then that is followed by the fair value of the stock. So stock seems to, for the most part, trade at a premium to the fair value. So honestly, we'd be looking at, for things to be in line with what they've been historically, we'd be looking at this stock to be more towards the 500 level, which we saw right before that decline. It hit 556. That might have been a little high. When the drop started, it just continued on. So I'd be looking for the stock to find an equilibrium point, hold in that range for a few days, and then start pushing back up. And that's when I would really be looking for some sort of trade or something. Next, cash flows. Cash flows see great growth, very well in line with that fair value, and earnings the same. So we see a very similar trend across everything. And when we get to the metrics, we're looking at the specifics on this page. So we're looking for gross profit percentage, 36 in 2019, 31.7, 39, 39.6. That's good. That's a nice trend. That's exactly what we were looking for. It was yellow. It could be considered a green then, I'd say. Expenses as a portion of revenue, we want to see trending down. 87.8, 94.3, 85, 83.9. That's also trending down. That's going in the right direction. That's what we like to see. Net profit percentage 9.5, 2.9, 11.4, 12.2. Great. So it looks very good on the financial front. It looks like they're really shoring up their operations, making things run smoother. Revenue growth might be slowing a little bit, but once you get to a certain point, revenue growth is harder unless they're going to buy out a competitor. Share counts on a really nice trend. That's really important because that'll help bolster all of the numbers. Free cash flow yield, very consistent, 10 to 11%. Consistency is something that we really like to look for. And aside from 2020 here, things look very consistent across the board. So this is what we're looking for. The debt to equity ratio. 1.56, 1.55, 2.1, 1.74. So I wouldn't exactly say that it's trending down. I think that's partially due to the whole pandemic boosting their debt in 2021 is when a lot of the expenses would have hit. And they took a huge chunk of it down in 2022. So they will likely be back towards where they were around the 1.5 level in a year or two. So I do like to see that. Yeah, it looks like it was a drop in the assets that led to that change in 2021. The assets dropped by nearly $2 billion. Liabilities rose by 100 million. But the next year they climbed right back up. So potentially it was just an investment or something on the books that lost a lot of value. We'd have to dig deeper into that. If this were considered to be a buy, we would do more of a deep dive into the annual reports and see what sector or what categories are bringing in what margins and what are their growth rates. How many locations do they have? How quickly can they open a location? And really get an idea of where this company is going in the future rather than just basing it on analyst expectations. But for a general investor, analyst expectations are a decent guide. And the last thing to look at would be the ROE here. So this is 137.1, 64.2, 63.4, 50.6. And that is assuming their typical margin in the 10% range, although things have improved, so we might be able to boost that up a little bit. Which would raise this number. And then the shareholders' equity, that would be 1% growth because that's what they've been experiencing, compounding over the last 3 years. And that is what we're looking at for the stock. So progress is being made where it needs to be made. We do see some revenue slowing, but the earnings per share are improving. So they're definitely improving operations, shoring things up. And the only other thing would be looking for the price to drop to improve this earnings yield. So we'd really be looking for this thing to go underneath 400. I think that it's going to, if it continues on its drop, which it definitely looks like it could, It's got a double bounce. We'll see if it tests essentially the fair value, 408, for a third time, and whether or not it bounces towards the positive or breaks through to the negative. But the next point where it's going to act like this is most likely around that 370 level. And we'd really be wanting to scoop it up at 350. But that's what I'm seeing on the stock. So historically, it probably was more of a growth stock. Looking at a lot of this growth, it's definitely becoming more of just a stable stock. It's one of the major players in the beauty retail space. So I am liking what I see. I am interested in the stock. I'll definitely have it on a watch list and monitor the price. And we'll go through the next earnings to see what's going on with it. So thank you guys for watching. Please like if you enjoyed the video. Comment if you have any other stocks that are towards their 52-week lows that we should take a look at. And subscribe so that way you can stay up to date with everything. And I'll catch you next time.